Well, hello, everybody, and welcome to the show. I'm John Bowens again with Equity Trust Company. Joining me today is Ryan Wright. Really excited to have Ryan on today's show. Ryan is an equity trust client. He is a real estate investor, licensed agent, been in real estate for nearly 2 decades, I believe, if not more. He has run businesses. He runs his own real estate business now. His company is DoHardMoney. You can find him on DoHardMoney through YouTube, Facebook, Instagram. He has a podcast called Income Hacker. And so I thought, what better than Ryan Wright to be on today's call with us to educate other equity trust investors or individuals that are interested in equity trust about what does it take to get involved in real estate, how does it work, and how to do it with a self-directed IRA. So Ryan is a real estate practitioner as well as a self-directed IRA practitioner. So really excited to have Ryan on the call with us today. Ryan, thank you so much for joining us.
Oh, I'm happy to be here. Thanks for having me.
Absolutely. We're going to jump right into it. Ryan, for our audience, if you could start off with talking a little bit about, what's your philosophy in real estate? How did you get involved in real estate? What was the purpose for you in really getting you to where you're at today and what your business looks like today?
Yeah, it's a great question. I mean, I always tell people I don't think I really had a choice. My grandpa was an HVAC contractor. On the side, he'd buy properties, fix them up, and sell them before HGTV and all those things were popular. This is a long time ago. My dad was a chiropractor, and he just knew the way to wealth, even though he had his day job. And I think this is a really important point because a lot of us have that situation. He's got his day job, but he bought plexes, duplexes, threeplexes, fourplexes. He'd buy one, he'd fix it up, he'd sell it. I spent the summers working with my grandpa, fixing up a fourplex, turn it into a sixplex, and painting and carpeting. And there's a lot of sacrifice that happens early on to make that a reality. But with time, when I saw that happen over a decade, I saw those property values go up. I saw money be made. So I knew there was money in real estate. That's kind of where it all started for me. And so I didn't know what to do. So I got my real estate license, and then I started helping people. Then I started doing, I kept buying plexes and rentals. Then I helped other people fix and flip. And then I started fix and flipping. Then I started lending. And now we provide tools and services to help other people wanting to get into the real estate investing game. And capital as well. So that's kind of the quick version.
Awesome. Thanks, Ryan. And we were talking before this and sharing some of our I guess you call it, sort of war stories and talking about on the shop floor what happens when you're running a real estate business as a either part-time investor or full-time investor. And I understand that there are folks out there that are part of our group that are full-time investors. And there are also people that are part-time investors. I consider myself a part-time investor. I spend most of my time representing Equity Trust Company and teaching and educating other investors on how to utilize a self-directed IRA. And then I do my own investing with my self-directed retirement accounts on my own time and in the after hours. And we were sharing our first deal, that first deal story. And, I know for me, it was, I was absolutely filled with fear, and all I had at that time was $23,000 in my retirement account. And I wanted to get started. I wanted to invest in real estate, and I made a private loan to a real estate rehabber, and I was very fortunate to get my money back in less than 6 months, and it was all tax-free. And, it was that first deal that then catapulted me into the second and the third and the fourth and so on and so forth. Could you share with the audience what that first deal looked like for you?
Yeah, I mean, the first deal for me was ugly. So I was 21 years old. I had seen my dad buy plexes, and so I bought a duplex. I probably paid full retail for it, even though it needed work. I was just so anxious to get in the game. And the play that I had was to turn the duplex into a threeplex. But I didn't realize you had to talk to the city and get their permission, and we had parking issues. And so I turned it into a threeplex, and then the city came out and said we had violations, and then I had to turn it back into a duplex. Then I turned it into a mother-in-law, and then I ended up moving into the property. The idea was to buy it, rent one side or two of them, and then live on the other. And in the end, one of the blessings of real estate is if you can hold on to it, you're usually going to make some money. And so years later, even though I bought it full retail and made probably every mistake you could have in the book, I ended up making money, and it catapulted me into buying the first house that we actually bought to live in ourselves. That wasn't an investment property. But yeah, it was it's one of those things where you can talk about the temperature of the water. You can put the thermometer in there, but until you actually jump in, you don't actually feel what it feels like. You don't know what that water feels like till you get in. And that was my experience on my first one.
That's us. Yeah. And so you went all, I'm the opposite. I started in private lending and now I own rental property. And private lending could certainly be a great entry point. But you got to do your due diligence on deals like that as well. Right. And, I've been involved and, could certainly tell horror stories of, deals that went south or, deals that, unfortunately didn't pay off to the expectations that I had. And,
Yeah.
that's just reality, of course. But for every one of those, right, you have X amount of deals that, end up being a home run or a base hit or a double. And now you really start to magnify your return. So Ryan, you also have experience with private lending, which it sounds like came after you actually got involved in owning physical real estate. Could you speak a little bit to your experience and maybe even what you do today in terms of private lending? Some people might refer to it as hard money lending, but I like to refer to it as private lending.
Yeah, no, I'm with you. Yeah, I'm an investor first. That's kind of where I came from. So a lot of people come from the banking world and get into money, lending money. I came from being an agent to being an investor. And one of the things I found, there was just such a need for hard money, private money in the marketplace. There was just such a need. When I was doing my first deal, I found it. I didn't know my first fix and flip. I didn't know how to get the funding for it. I had some money. I didn't have a lot of money. I had good credit. I didn't have amazing credit. And I needed somebody to do a deal for me. And I found a guy named Dan, and he funded the purchase, the rehab, didn't have me make any payments until I sold the house. And that guy literally changed my life. And so as I've done my own fix and flips, as I've done wholesaling, as I've done rentals, I've always wanted to be able to help other people as well. And lending was a natural fit for that. So one of the things that we do now is we lend money. So we'll lend the purchase, we'll lend the rehab. Lots of times we even lend the closing costs if you buy a good enough deal to people. And what we do is we take private investors that have capital, and we have people that need money, and we vet the deals and find those and match make the two of those together so that people with money can have good opportunities and people that need money can get access to that and put a platform together with those. We can take care of those transactions for people. So that's kind of the big stuff that we're doing right now.
That's great. And Ryan, I'm glad you brought that up because one of the questions that a lot of investors will have about equity trust and self-directing a retirement plan and how does that work from a financial institution perspective is we don't provide tax, legal, or financial advice, and we don't do due diligence on the investments that individuals make. It's up to the client to direct the funds. They give the direction to equity trust, and we process the transactions. We provide a lot of education and training and information, but where we don't cross the line is providing advice or doing a background check on a borrower or due diligence on a specific investment to determine suitability for that individual's portfolio. And that's really the beauty of a self-directed IRA is the ability to be able to take control and make all of those financial decisions. And you're obviously a great representation of doing that, performing the due diligence. And you obviously have a long history of, successes, but I know some failures along the way that you've learned from in order to, do a better job of performing that due diligence as it pertains specifically to private lending, because I know you have a lot of experience with that. And I know you're doing that with your self-directed IRA now. You're lending money secured by property. So it could be an example of a deal that you've done in your IRA, but it could be a deal outside of your IRA. Could you share a little bit about maybe one of the experiences that you've had that maybe wasn't as favorable and what the lessons were that you learned from it from a due diligence perspective?
Yeah, absolutely. There was a property in Virginia that I ended up doing a loan on. I was actually the private money lender, and it was through I can't remember if that one was cash or if that one was through my Roth. But we gave a loan on the property, and one of the things that we found out pretty early, the borrower ended up not doing the work like they said they were going to do. Keep in mind, there's more risks if you just lend the money for the purchase and the borrower's putting a bunch of money down, there's less risk. If you're lending the money for the purchase and the rehab, there's more risk, right? So it's this risk reward, how much I can charge versus what they're doing. But on this specific property, the borrower didn't finish the rehab. So, and I think where we could have done a lot better, and we've now changed this, is ensuring that work got done by doing forced inspections, getting people out there, making sure the work was getting done on time. And the second big problem that we had is we've had work get done, but the quality of the workmanship just wasn't there. And so we had an inspector go sign off on something saying this is good, but it ended up that it wasn't good and it had to be torn out and redone all over again, which is really expensive if you pay for it twice. So we ran into some situations like that. The other problem, this is a horror story. The other problem is this little house was in a pocket of just really bad area. Everything around it was pretty good, but there's just this little pocket that was just a bad neighborhood. And we looked at this and looked at values, but it really seemed like there was enough values in the area. But really, I couldn't go more than just a few blocks to get values, because the ones in this specific neighborhood were selling drastically less than the ones just a few blocks, 5 blocks away, a mile within the mile radius. And so this is early on. We've learned so much since then. But the idea was, number one, don't overlook comparables. I find that's a big thing that private investors make mistakes on, is they, really look for the most expensive house that's ever sold and say, this is what it's going to sell for. And we flipped that and said, let's think like a buyer thinks. A buyer is going to say, what's the least expensive homes that are out there? And they're going to work their way up until they find the ones. And then when you find a few of them, those are the ones I'm going to go look at. And if those meet criteria, so I'm going to buy that. I'm not going to start with the most expensive. And so we've started looking with that. The other thing is how we manage general contractors and what we require and put them through and make sure they're licensed, and how we do inspections. And we've learned a lot from that horrible experience. And I think we lost $30,000 on that loan that we actually gave. And it's really easy to cry about that. I hate losing money on any individual loan. But keep in mind, I have to look at the overall portfolio and how many loans I have out there and what my rate of return was on all of the loans that I was actually doing. And I can do a few loans and make up that loss pretty easily. But I can also not have to go through those problems and get some help with due diligence. And that's not going to solve everything. You're still going to get some bruises, but it should eliminate a lot of the big problems that you're running into if you've got some due diligence that's being done appropriately.
And so with someone that might be brand new to lending, getting involved in real estate, and that's what their entry point is. Maybe it's not owning individual properties to start, whether it's a rental or do a fix and flip deal or a wholesale deal or real estate option. Maybe it's lending money to another investor. What would be the best first step for someone to get started in that particular space?
Yeah, I think it depends on your experience level. Like if you have some background, but if you're saying their entry point, they don't have experience in real estate. Let's say it's a doctor or a lawyer or a CPA or whatever the case is that's got money, high income, wants to self-direct it, wants to get in the lending game, but doesn't have the real estate experience. I mean, one thing they can consider is finding somebody that can help them like that, a mortgage broker or somebody that has experience doing due diligence, something like we do, so that they can help them say, here's the rules we recommend you play by, and we'll only bring you deals that fit these rules. Because one of the biggest problems you have if you don't have the real estate experience is finding deals. Finding deals is hard. We get over 200 loan applications, and we end up closing on a dozen of those in a month, because so many of them, the big mistakes people make is they overvalue the property, they underestimate the repairs, and they don't do a great job on the project management, getting the project done on time and on budget. Those are like the 3 cardinal sins. Don't overvalue the property, don't underestimate the rehab, and make sure the work gets done on time and on budget. And anything you can do to make sure those 3 things are happening is going to be put you ahead of the game. The other thing that you really run into is it's a risk and reward. Some people may say, oh, I saw this guy charging 5 points, and I saw this guy charging 2 points and 12% or 15% and that stuff. It's all relative, because the reality is you take on more risk. And so if you're working with a borrower that's never done it, you take on some more risk. If you're working with a borrower that has not a lot of money into it, you take on some more risk. If you take on a borrower that doesn't have the best of credit, you take on a little bit more risk. If you take on a borrower that maybe has some experience in the industry and has done a fix and flip, you take on a little less risk. So it's this whole risk reward ratio. And one of the things I'd say for people just getting started is, where's your tolerances? And maybe you need to bucket out your money and say, hey, I'm going to do lending. I've got $500,000 or $1 million, whatever the case is. I'm willing to put 20% into higher risk loans, 20% into your easy loans, and 20% or 25%, whatever the ratios you want to do there are, and bucket that out for yourselves, because it's going to be really tempting to do some of these loans that are really sexy on paper where they make a lot of money, but there's a higher risk that comes with that. Whereas if we're dealing with loans that are maybe a safer loan that'll produce a lower return. So realize there is a risk and reward. Not every borrower is created equal. Not every property is created equal. You've got to look at it as a holistic approach.
Okay. And so I asked you, Ryan, about the, one of the transactions that didn't go so well for you. Tell me a little bit about a typical deal that you would see, a typical private loan that you would see.
Yeah, it's a great question. We typically lend about $150,000 is a typical loan. Purchase price or acquisition is probably around 120. There's probably $30,000 worth of rehab, give or take, although we've seen rehab been going up over the years. And then that property is going to sell for, let's call it 200 or 215 is what that property is going to sell for. As a lender, we're looking for points in or origination fees is anywhere from 2 to 6 in origination fees, depending upon the deal and complexity, and interest rates ranging anywhere from 12 to even 18%, depending upon the deal itself. As an investor, if I'm investing in that type of a deal, we're typically seeing our goal is to see double-digit returns all the time. Lots of times we'll see deals we make 20% on. Sometimes we'll see deals that we're going to make 10 or 12% on. But that's typically what we're looking for. I think most investors, if we're looking at it, probably somewhere around that 15%. If you average out the losses and some of those things, is probably where you end up, as long as you can spread yourself out. You've got to have enough deals going that if you have one deal that goes bad, if you get the bad deal of the year award, you don't want that to sink you. You've got to make sure you're diversified. And something like us, we don't diversify for you. That's something you do on your own by having multiple deals. We don't pool money and bring everybody's money together. And so it's something you've got to think about for diversification.
Okay. And so I asked you about the I guess the worst, medium, middle of the road. What about the best deal that you've done, whether it's in a private lending type, private debt type instrument, or even physical property or real estate partnership? What's the best deal you've done?
Yeah, I mean, it's got to be a little office building I bought. So it's a little office building. I kept my eye on it for 2 years. The property was in foreclosure. I made offers then. The property got foreclosed. I made offers then. The note got sold from the one lien holder to another. I made offers then. And finally, they ended up accepting one of my offers. And so the property had been sitting for 4 years, I want to say. It was a commercial office space. It was a standalone building. I bought the property for, I want to say it was $200,000. It might have been 175. I bought it over 10 years ago. This is my best, one of my best, I should say. We dumped another $100,000 into it. So I'm into it about 350, let's call it. It cash flows. I've got 2 tenants. I've got a pulmonary rehab, and then I've got a nurse practitioner. And between the two of them, we get about $6,000 a month in rent off of $350,000 investment. And we've owned it for over a decade now. That's a cash cow. The ROI on that is amazing. Actually, there's a developer that asked to come buy it because they wanted to do a development around there and everything else. And I started running a pencil to it. I'm like, dude, you're going to have to pay me like $1.7 million to sell this thing to replace the cash flow. And they're like, it's not worth it. And I said, then it's not worth it for me to sell. So they're trying to do this development all around my property because it just doesn't make sense. And they're even talking about buying it and moving me on the other side of the project and giving me a brand new building for this old building that I have because it'll fit within their plans better, because it just doesn't make sense for them to pay what I would have to get out for the cash flow. So I would say that's one of them. I've had some other fix and flip deals that have been some home runs, and I've had some wholesale deals that have been great wholesale deals as well. So I hope that helps.
Yeah, that helps a lot. And hey, Ryan, I'm glad you brought up wholesaling because this is a good time to ask about that for investors that might be, just getting started in real estate. Could you describe what does a wholesale deal mean? And maybe if you can give an example of a deal that you've done in the past.
Yeah, absolutely. So wholesaling basically is that you secure a property and you sell your interest in that. So basically, I go and find a deal. I put that deal under contract. I did one, I don't know, a few months ago. I can't remember the specific numbers. I think we were buying it for, let's just call it $200,000. So I went and found a property, talked to the seller. They want to sell. They need cash right away. I say, this is what I can pay. We negotiate. I get under contract for $200,000. Then what I do is then I go and find some buyers, typically some cash buyers. I know some rehabbers in the area. And I said, hey guys, how much would you be willing to pay for this property? I took pictures of it. I sent them the pictures, everything. I've got it under contract. And I said, hey, I think this is probably worth $240 in its as-is condition. And they got back to me and said, we think it's worth $230 in its as-is condition. I said, okay, well, I'm buying it for $200, I'm selling it for $230. So then I wholesaled it to them. So basically what I did is I can either assign the contract to them where they give me $30,000 and then they go and close on the transaction and I do an assignment over to them. Or and there's some state laws depending upon a few things. Or what I can do is I can close on the transaction simultaneously where they bring their funds, I take their funds and I close and I get $30,000 and walk away. And in some cases, and this can be great for your private lenders, in some states you actually have to do, I call it flash cash, where the transaction actually has to close with separate funds. And this is a great investment for somebody with a self-directed. In some of the states, you actually have to bring the money. The guy that's a wholesaler actually has to bring the money, and the new buyer has to bring the money, so they're separate funds. And so you typically have your money out for a day or 2 days, and then it records, and then your money gets back. And so you can make we usually charge 1 point to do that. So that's kind of a flash cash. So there's different strategies on how to do it. But the idea of wholesaling is finding a good deal, and rather than you fixing it up, rather than you taking on the risk, you can sell that property to somebody else before you own it in lots of cases. And sometimes you actually just close it simultaneously, which works out really well. The thing I like about it for people getting started is it's pretty low risk. You only buy the property if you have someone that's willing to buy it from you. So you're taking on very little risk. And it's a great way to get started. And you don't need a lot of money. You just need some earnest money. And then you can do a assignment.
So Ryan, it makes a lot of sense getting a property under contract like that. And, when I first got into the business and I first learned about wholesaling properties, my thought was, okay, you go to the MLS, right? And you find deals and you approach realtors or sellers. And, if it is a for sale by owner type situation, and, you make an offer. But unfortunately, what I learned very quickly is that there's really no money to be made there, right? Most people aren't going to be willing to accept the offer that you're going to make. You really have to find the deals, the off-market deals, where there's an inefficiency there, right? The seller could be a probate property, could be a homeowner, absentee homeowner, could be somebody that's in a stage of foreclosure, right? You have to find someone that is motivated and willing to sell that property for under market value so that there's opportunity there, or it needs to be fixed up substantially so there's opportunity for a rehabber. There's good money for them. There's good money for me on the wholesale side. How do you find deals, or the individuals that you might network with? How do you find those off-market deals that are good wholesale opportunities for you?
It's a great question. Like, I want to wear a t-shirt that says anti-MLS, right? MLS with a line through it, because it has killed so many dreams of real estate investors. People delegate their success to an agent and say, hey, how are you going to find properties? I'm going to call an agent. I am an agent. My wife's a broker. Like, I'm not an anti-agent guy. But if your hopes and dreams are on how to make money in real estate, calling a real estate agent only happens after you found the property, not before you found the property, because that agent is not going to find you those great deals. Now, there are some one-offs, and I know people are going to email me, I found this great deal through an agent. Yes, it happens. I'm not saying not to discount it, but that can't be your primary strategy. And you nailed it. It's equity and it's motivation. You've got to combine the two. So what we do, and we build a software around it called Investor's Edge, we look for equity and we look for motivation. Equity is the difference between what they owe and the difference between what the property's worth. So what we do is we run AVMs. It's an automated value management system. A bunch of people may be getting refinancing right now. And if they're doing that, if they have enough equity, the bank just does an AVM, which is a computer generated that says your home's worth $300,000, and they'll lend based upon that as long as there's some equity in your home. We have access to that as well. And then what we do is we do what's called a reverse amortization. So we go back to the year when the loan was created, because we don't know how much exactly is owed, but what we do know is how much they got a loan for. And if they got a loan for $200,000 10 years ago, we can do a reverse amortization. What we say is, what were the average interest rates 10 years ago in 2010? What were those average interest rates? And once we know those average interest rates, then we do a reverse amortization. And assuming they made their payments, we say, okay, they currently owe $175. So 175 versus 300 on the AVM tells me that there's $125,000 worth of equity. That checks that box. So I'm mashing the data together on both of those. Then I have to check the other box, which is motivation. So then I look for public information. I look for people that are going through a divorce. I look for vacant dwellings. I look for out-of-state owners. I look for non-owner occupied properties. So I'm looking for all these different things, bankruptcies, you name it. So anything that's public information I have access to. And then I mash those two together and say, I've got equity and I've got motivation. So those are the people then I need to call, I need to email, I need to knock on their door. I need to do a skip trace, whatever the case is, so I can actually get their phone numbers. We have a software that we put a lot into that does those types of things. But there's money created in two ways. I just want to highlight this real quick. You make money by negotiating and finding a good deal. And this isn't taking advantage of somebody. This is actually helping them solve a problem. So I helped a family. The grandpa had to go into the rest home. They put him in there because of health reasons. He had equity in his home, but the home was really beat up. Nobody had money. And those rest homes, they're expensive. They're $2,000 or $3,000 a month. Family could cover the first month, but not the second month. They needed money, and they needed it in a couple of weeks. They knew they were selling for a discount, and I was getting a discount, but they were getting the money they needed. The payments on the house didn't have to be made. Everybody was happy. They write me thank you cards every Christmas and say how great I am because I helped them. That's helping somebody. They knew they were getting a discount, but they didn't have a lot of alternatives because there's not a lot of buyers that can go out there and say, I'll buy it the way it is. Don't worry about it. And I even said, leave all his personal belongings that you don't want. Take what you want out. I'll take care of everything else. And because it's emotional to go through everything. Like, take the stuff you want, I'll take care of everything else. And the other way you make money is also value adding. So I can make money by finding a good deal, and I can make money by adding value to the property by doing rehab. And I should be making money on both of those levels.
That makes a lot of sense. And I appreciate it, Ryan. We didn't even have planned for that, but the integration of technology in real estate, when I got involved in real estate investing, I worked for a real estate company and never really had any exposure to this whole world of being able to find off-market real estate transactions. Everything for me and my background was, MLS, maybe an occasional referral from a broker or agent, but by and large, it wasn't this world of using technology to find deals. And so I think it's really important for the entire audience here to take note that you could go and in a neighborhood and you could look up every single property. And by the way, I've done this before, driving streets, right? Look at houses and then try to go on public forums, right? You go to the county website and you can look up taxes, and you can look and see the last mortgage that was filed and try to use a reverse amortization to determine what do they probably still owe, right? Assuming that they consistently made their mortgage payments. And there's a lot of work, right? And I'm sure you've done direct mail before. I have as well. Obviously that it's a lot of work, and sometimes it becomes very much I'll call it sort of shotgun approach to real estate investing. And not that that's a bad thing, right? I mean, sometimes that's just where you got to start. But with this technology and this software and these systems that people can gain access to nowadays, you can take very much a more targeted, much more of a sniper type approach to investing in real estate. And it sounds like, Ryan, to me, that's exactly what you're doing. Is that correct?
Absolutely. Yeah. Ours is called Investor's Edge. And we really believe it gives the edge because it makes it easier. Now, you still have to do a lot of work. So even with that, it's not, I found this great list. Why doesn't everybody want to sell? Then it comes to timing. If I'm mailing to out-of-state owners or non-owner occupieds, it's probably a rental property or a property. Non-owner occupieds is probably a rental property, right? If it's not a vacation home, it's a rental property. And non-owner occupied means the tax bill doesn't go to the house. It goes to a different property, which tells us it's probably a landlord situation. But I can mail to those guys, or I can call those guys, but I have to keep working them because they're not going to sell until they have a need, which is usually they have a tenant that destroys the house and they're like, I'm done. I don't want to be a landlord anymore. One of the postcards I like to send out is a picture of a criminal that says, I'm your tenant, and so just stuff to play on where people are like, hey, when you're sick of this, that's when you call me. So I'm still waiting for the right opportunity, and I've got to be there. But if I'm there when the right opportunity happens, that's when a deal happens. That's when the deal gets made, is being available when the opportunity presents itself.
Gotcha. So you're using this technology system, you're rendering addresses,
Mm-hmm.
you're sending postcards, you're sending letters. potentially even finding phone numbers and making phone calls,
Yep.
or maybe
Yeah.
door knocking, so on and so forth. So you're approaching the seller in a solution-based or solution-oriented fashion, understanding their specific needs and desires, right? Doing it in the appropriate way as a real estate investor, and making an offer. And like you said, in the commercial real estate opportunity, it took you 4 years
Yeah.
after multiple offers. So lots of offers, but you find deals and then close on those deals, whether it's a wholesale type arrangement, or possibly it sounds like you also have bought some of those properties and rehab them yourself. So you got both the equity side and the value add rehab side.
Absolutely. Yeah, absolutely. And, thinking long term, like we've talked about, the other thing you do is keep a few of them. You buy some, you keep some, you rent them. There's lots of opportunity when it comes to real estate. As you find a good deal, what's going to be the best way for me to make the deal happen?
Outstanding. Hey, Ryan, I appreciate so much. I have one last question for you that I want to ask. And certainly, let me preface this question with none of us have a crystal ball. On behalf of Equity Trust Company, I mentioned that we're non-fiduciary custodian. We're a regulated financial institution. I know, Ryan, that you certainly, from a regulatory perspective, you want to make sure T's are crossed, I's are dotted. You're running a real estate business. You have employees, so on and so forth. You want to make sure that you do things properly, just as we do. And so I want to preface it with, none of us have a crystal ball. We can't provide recommendations or solutions, but I'm curious to know, just putting yourself in your shoes as an investor and running a real estate business, and having all the exposure to real estate. What are you looking at in terms of with this national and global pandemic? Obviously, we're starting to see statistics on C-class apartment buildings and properties. We're starting to see mortgage foreclosure statistics come out, forbearance statistics come out, right? That data is starting to funnel in now. I'm sure you're looking at that data and have access to a lot of that data based on what you do. Where do you see the opportunity for your specific business, and what are you planning for in the future?
Yeah, that's a great question. Yeah, no crystal ball, but here's what I'll say. Fundamentally, I went through 2008, and that was a huge, huge upset. That was a huge crash, real estate crash. And I learned a few things. And what I learned is the guys that were doing the high-end properties got desecrated. And people like me that were doing the sub FHA deals actually did okay. It wasn't our best years, but we actually did okay. And so one of the fundamentals we've always said is we don't do commercial properties. I have a few commercial investments, but for the most part, as an investor, we're investing in single family houses, maybe up to a fourplex, but typically single family houses. And with that, we are under the FHA loan limit. Because what we find is FHA, that's where the majority of the buyers are coming from. So you can look up the FHA loan limit in your area, and you want to make sure you're buying or lending, 70% of what that is. So if it's 400,000, you want to be, what's the rough math, 320. So you want to make sure that's where you're at when you're doing your loans. That alone was the number one thing that saved us in 2008. Is because what happened is the high-end properties got desecrated. I bought a house. The builder had built it. He was $1.8 million into it. And I bought it for $500,000. No one had ever lived in it. And the bank seller financed it. So that's the type of stuff that we saw. But if you took a house that was like $250,000, it might have gone down to $200,000. So when we say real estate drops or that type of stuff in a crash or a worst case scenario, it doesn't drop as big. It's proportionate, right? It's going to drop a whole lot more percentage wise on the bigger properties than it is in the smaller properties because there's more movement, there's more turn, those types of things. I'm blown away by what's happening right now. How can we have unemployment at 10% and real estate is flying off the shelves and values have gone up 8 or 9% just in the last couple of months? So there's all this stuff. Yes, is it artificially inflated by the interest rates and that type of stuff? Sure. Here's the thing though, as an investor also, if I can staying power is key. So number one, stay in the markets where there's the most majority of buyers. We know there's the most transactions. We know the funding's going to be the easiest. We know FHA is going to keep wanting home ownership. So staying in that marketplace is a key for us. Is that the key for everybody? Probably not, because there's way different ways to skin a cat. But that's been our philosophy, staying under that FHA loan limit, or the median price range for your area is a big thing that we like to do. And so I think that gets you most of the way there. The other thing that you do is make sure you have an exit strategy. So with each one of our properties, we like to look at it and say, worst case scenario, if I have staying power, I'm okay. So what can I rent this property for? If it's a down market, what can I rent this property for? And can I hold that property with those rents so that it can come back up? We had a property in 2008. We turned into a rental property. We made probably a 3 or 4% return on our money, but 6 years later, we sold it for $100,000 more than we were into the property because we had the staying power. And that's the thing. Real estate always goes up. It will always, 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 always go up. I saw a statistic that in the last 10 years, real estate went up more than the GDP of every single country in this world, except for America and China. The value of real estate went up more than the GDP of all these countries. And so we'll see that. The question is, what happens along the way? And if you have staying power, and you stay under that FHA, I think those are the two keys to success, regardless of what happens in the market.
It's outstanding. And Ryan, I do have one other item on our agenda for today, because you are a self-directed IRA practitioner. And this show, of course, is, if you will, supported by self-directed IRA investing and equity trust. That's what we do. We help investors use IRAs, 401ks, and other retirement accounts to invest in real estate. Now, the self-directed IRA is, of course, the vehicle, right, that gets someone to that point. And the self-directed IRA in of itself, like I always tell everybody, does no one any good. If you set up a self-directed IRA and you put money in it and you don't do anything, you're not going to make any profit, right? So the key is understanding real estate investing. And that was the purpose of a lot of what we've talked about today, is understanding real estate investing, understanding how to find deals, how to put deals together, and ultimately take action, right? It's about going out and finding the deal and stepping through it and learning from your mistakes as well, just like you had mentioned before, which there were mistakes on the front end, but in the long run, it ended up being a really great deal. Could you share with the group, with all that being said, a little bit about what you've done with your self-directed retirement plans?
Yeah, absolutely. So, I mean, we started just like everybody else and started small. I can't remember the first transaction. It's been like 15 years plus. I can't remember if we did a wholesale deal or if we just waited until we had enough money where we could actually do a lending type deal. I know we did a few fix and flips and then some lending. So primarily what we're doing is lending right now. We've got a property we took back where we had to foreclose that we turned into a rental property, but primarily notes is what I'm holding, where I've actually been doing a loan on a specific property. And so that's what I'm doing mostly with my, and I have a Roth as well. I'm a big fan of the Roth. And so that's primarily what we've been doing. I've combined that with my wife. So I'm using my wife's and mine as we make some of these different investments in short term, typically lending short term. We like to see our loans 6 months or less because back to your question on market fluctuation, I feel like if I have a 6-month loan, I can reassess things and then extend it if I want to. But those are some of the types of things that we're doing is mostly lending.
Okay. So mostly, and then you had mentioned something about investing in like limited partnerships or LLCs. Have you also participated in those types of investments?
I have, but I've actually done that with cash. So I've done some of those for cash flow purposes to actually help with income, with residual income. But I do have one limited partnership that I'm looking at that is more of a long-term play. So basically for my personal thing is if it's going to be cash flowing, I typically invest with cash. If it's going to be a long-term where it's appreciating, that type of stuff, I invest in my Roth. And if I don't need the money, I invest everything into my Roth as well. So I kind of play the game when I have investment opportunities like, hey, is this going to produce immediate cash flow now for me? If so, I look at potentially doing it as cash. If it's not, or if I don't need the money, then I'm pushing it over into my Roth. That's kind of how I play the game.
That makes, Ryan, I'm really glad you said that, because I've had investors that will come to us and they're looking at a self-directed IRA and they're thinking almost singularly dimensional, if you will. So they're thinking, I have to do every deal in a self-directed IRA, or I do no deals in a self-directed IRA. And that's really not the case, right? Some people, they get to a point where they do every deal in their self-directed IRA because maybe they're in their retirement years. And so all their profits they make, they can take out right away and it's tax-free. But other investors are running a real estate business. They need retained earnings to recapitalize and reinvest into more deals and new deals. And some investors I have found it's a ratio of 1 to 10. So for every 10 deals they do outside of their IRA, they do one inside their IRA. Some people it's 5 to 1. Some people it's 4 to 1. Some people it's 2 to 1. And it also depends on whether someone is a full-time real estate investor or a part-time real estate investor. So obviously somebody that's a part-time real estate investor that still has a 9-to-5 job, if you will, they're still working full-time, they haven't officially retired yet, they're going to invest part-time. Those individuals might be for, every 2 deals, they might do 1 deal in their self-directed IRA and they're only doing 3 deals a year. I have a lot of investors that they only do 1 transaction a year in their self-directed IRA. A lady here in Cleveland, Ohio, for example, she bought a property. It was a foreclosure. She bought it for all-in purchase and rehab was about $100,000. She made about a $30,000 profit. So her return on investment was 30% on just 1 transaction. Mm. And it was in under 6 months. She kept her money in cash for the remaining 6 months and didn't do anything with it. And that's okay, right? At the end of the year, her annualized return on investment was still nearly 30%, which was much better than what she was making before in the traditional financial markets. So, it's okay.
But make no mistake. The goal is to put as much as possible into the Roth, as much investment as possible into the Roth. That's really the key for us. So whether you're self-employed, you run a business, or you have a 9-to-5 job, I say this all the time. You have 2 jobs. Your first job is to keep food on the table, keep the family taken care of. And your second job is your retirement job. It's how are you going to build wealth long-term and compound that? And so you got to play both those fronts. So even if you're working for yourself, you've got to take some money to take care of yourself, and then you got to pay yourself long-term where you can grow your wealth and grow your cash flow. And you've got to be playing both sides of that.
Absolutely. Well, hey, Ryan, thank you so much. Ladies and gentlemen, everybody on today's call, again, this is Ryan Wright, real estate investor of DoHardMoney is his company. He also has a podcast, Income Hacker. So you can check out Ryan on Instagram. I've been following him on Instagram, YouTube as well. He has a variety of videos that you'll see on there on a variety of different topics. And so I'd encourage you to check that out as well. So Income Hacker is the podcast. And then you can search DoHardMoney and you can find him on Instagram, YouTube. I recommend subscribing and plugging into that to take advantage of some of that content. With that being said, Ryan, any final comments or anything else you want to mention?
Yeah, if somebody's looking to do some lending deals and want some help with that, you're welcome to check us out. Or if you're looking to get started, don't have a lot of money in your retirement account yet and want to do some investing deals and need some capital for that. So those are some people that we can help. There may be a good fit there.
Awesome. Well, hey, Ryan, thank you so much once again. Really appreciate you taking the time out of the day to help educate our clients as well as our prospective investors going forward. And look forward for everyone joining us on the next show. Thank you so much, Ryan.
Thank you.